Audit planning and fieldwork. What is audit planning? Audit planning means strategy that involves expected nature, timing and extent of the audit. Why we need planning in audit. It is to avoid misunderstanding with the clients. Next, it is to ensure the possible problems are recognized immediately. Third, to conduct an audit efficiently and smoothly. And to know the scope of audit work. Step in audit planning. Pre-planning, client's acceptance. Understand the nature of client's business and industry. Evaluate the risk in client's business. Perform preliminary analytical procedures. Set materiality. Understand internal control. Collect the information to evaluate fraud risk. Develop overall audit plan and program. Pre-plan client acceptance. This step is divided into 4 tasks. 1. Client acceptance and continuance. The audit firm should investigate the client and his company background before make acceptance decision. 2. Identify the reason or purpose for audit by client. 3. The auditor should get an understanding with the client by sending an engagement letter. 4. Appoint staff or audit team to carry out the audit work. Scope of audit work is divided into 3 categories, which are engagement letter, fraud and error, and setting audit objectives. Engagement letter is an agreement between the firm and the client for conducting the audit work and related services. Purposes of engagement letter are: A. To confirm the acceptance of appointment. B. To show the scope of audit work and also their responsibilities and objectives in carrying out their duty. C. It will protect them from legal liability. D. To avoid misunderstanding between auditor, fraud and error. Fraud is an intentional act and misstatement the financial statement which is intended in personal gain. While error is an unintentional mistake in financial statements such as mathematical error, misinterpretations of facts and misapplication in accounting policies.
Management assertion is a set of claims made by the members of management following certain aspects of the business. Auditors will verify the authenticity of these assertions by running certain audit tests. Under transaction-related audit objectives, there are 5 aspects auditors need to look into, namely accuracy, classification, completeness, cutoff, occurrence. As for balance-related audit objectives, there are only 4 aspects auditors need to look into, namely completeness, existence, rights and obligation, and valuation. Auditor should have knowledge of client's business and industry. This is important to recognize error in financial statement, able to make judgment of client's accounting policies, its principles and procedures, enable auditor to easily identify unusual transaction and interpret audit tests and evaluate its effect. This knowledge also help auditor in developing positive relationship with their client by understanding the philosophy of the company, able to understand the entity's business strategy and plans, and gives advices to client to help boost their business. Industry and external environment talks about a risk associated with all clients in certain industry. In this case, auditor have to take into account in determining whether or not to serve a particular client.
What is client business risk? It is the type of risk where the client did not manage to achieve its objective associated with reliability of financial reporting and compliance with laws and regulations. So what the auditor should do is to analyze the risk and estimate on management control and material misstatement for the risk confronted by business.
Analytical procedure is applied during planning stage of the audit to gain more specific understanding and to determine the potential risks involved in the calculation and differentiation of recorded amount to auditor expectation.
Next, we will discuss about materiality. First of all, what is materiality? Information is considered material when the misstatements of it could influence the economic decisions of users taken on the basis of the financial statements. Next, what are the concepts of materiality? The first concept of materiality is it is the criteria used by the accountants and auditors to differentiate between unimportant and important matters. Second, in the case of material misstatements exist, The auditor shall bring the matter to the client's attention to take actions to correct such misstatements. Third, using sampling techniques are allowed and therefore audit job could be performed and completed on a reasonable cost. The reasons why we use sampling techniques are because the accounts cannot be perfectly accurate and such small errors are allowed, and the financial statements may contain misstatements that could change the decision. There are two types of materiality. The first type of materiality is quantitative. It is a financial effect caused by the misstatements. For example, our percentage of production or sales volume and percentage of total capacity. The second type of materiality is qualitative. It is the potential effect of the misstatements on trends, especially trends in profitability. For example, compliance and business ethics, economic trends and political realities.